Hey guys, welcome back to the Mark Loeffler Experience. So excited you guys came back again. And if it's your first time here, guys, welcome. In today's video, what we're going to talk about is buying your first investment properties, the good, the bad, the ugly. And we're going to walk through some of the numbers on what that looks like for you and why real estate is the best investment out there, or one of. There's tons of things, yet this is probably the easiest and simplest way to build wealth that anybody can do. You do not have to be a rocket science and have a degree in math to be able to figure out algorithms and all that type of stuff. This is super simple. So we're going to go through some super simple numbers and talk real estate, guys and girls. Okay, so let's talk basics on real estate investing. Number one, what do I need to have to be able to invest in real estate? Well, if you're going to invest for yourself, by yourself, not have a partner, then you need to be able to qualify for a mortgage. You can qualify for a mortgage. You've talked to an investment mortgage broker, build your team, right? And you're approved. You can go out and you can qualify to buy an investment property. Perfect. What's next? Typically, you need a down payment, right? You need to do your first deal, you need a down payment. You need about 20%. So if you're looking in a $300,000 to $500,000 range, you're looking anywhere from $60,000 to $100,000. You need some closing costs, anywhere from, say, let's talk about $10,000 to $15,000 closing costs. Maybe some repairs at first on the property. I mean, if you go back and watch last week's Burr, we talked about buy, renovate, refinance. We ran through some quick numbers there. There's always some costs when you buy a property. It's just going to come up. That's just how it works. So you have your down payment. You're good to go. You can qualify. You're looking at properties. Let's run through some numbers on some properties and we'll take it from there basically, okay? We're talking about a $500,000 property. Now, I know some of you live in places where a $500,000 property might be a condo. $500,000 property might be a luxury property. And if you're in one of those areas, you obviously can buy, and I'm going to run through some numbers on like a single family or small multis in some other areas. This is just close to where I live and close to where I invest. So, and the numbers still all work. So $500,000, we're looking for a $100,000 down payment. Okay. And I say, $10,000 in closing costs. Obviously, because we live in the great province of Ontario, we have land transfer tax, pay the lawyer to close, and we pay for title insurance. So we're in for about $110,000 plus, if we're not doing major renovations to the project, maybe around $10,000 in renovations just to clean stuff up. Paint, maybe redo some floors, some lighting, just to bring up that appeal. So our total cost in is $120,000. We could put it up here for now because we're going to come back to that. All right, so $500,000 property gets you a duplex, and we can rent up the upstairs for probably around $1,800. And we can rent the downstairs for about $1,450. Now, I honestly think we can get better rents on a property like this, yet I'm going to be I'm going to underestimate everything. Because I'd rather you call, hey, Mark, you're a liar. I bought a property and I paid that much for it. I got way better rents. That's fine. Yet I'm going to go through this and show you can make almost any investment work, any investment property work. If you can get better numbers than this, you can better cash flow, you're trading off something else, yet it all works out in the end. So stick with me, guys. And guys, if you haven't yet, go down, like and subscribe for all these great YouTube videos that I'm making, and I really appreciate it. And apparently, if you guys click the notification bell, as soon as I upload a video, you guys are going to get notified so you guys can be the first to watch it. I know that's everybody's goal in life, is to be the first person to watch my channel. I get it. We all have to have goals. All right, back to the drawing board, guys. All right, so we're getting rent. Total is $32.50. All right, so we have a $400,000 mortgage. So our payments on a $400,000 mortgage are going to be about $1,800 a month. Our property taxes, so here's our income. Now we're going to go through our expenses. So our mortgage is around $1,800, anywhere from $1,600 to $2,000. So we're just going to go right in the middle, $1,800. Our property taxes on a $500,000 property in St. Catharines or Hamilton is typically around $350 a month. So we'll go $350 a month. What other things do we need to pay for? So number one, are we managing the property ourselves? Even if we are, I'm going to recommend you put this number in there, because once you grow a portfolio, if your goal is to grow a portfolio of any size, then you're going to want property management. And property management is going to cost you about 8%. So on 8% of this is, what's that? $260. Okay? Are the tenants paying their own hydro? Are the tenants paying their own heating? So typically we pay for heat and water, and the tenants usually pay for their own hydro. So we're going to estimate that to be around $250 a month. All right, so we got mortgage, property tax, property management, and heat and hydro. And then we have insurance. You got to pay for insurance. And it's going to come right in probably around $120, $125 a month. Let's just call it $150. Overestimate. What else do we need to have on here? Well, what do all houses require? Maintenance. That's right. So maintenance, I typically budget around 5% of my total rent. So that's going to be around $150, $165. All right. So we have mortgage, property tax, property maintenance, heat and hydro, insurance, maintenance. What are we missing, guys? Just shout it at your computer, guys. What are we missing? And no, it's not smashing the like button, but you should. Vacancies, vacancies, vacancy, vacancy. So Hamilton, the vacancy rate's around 2%. We're going to go ahead and use 3%. And we're just going to say it's around $100. It's less, yet let's just keep the math easy. All right, so we have that. So we're going to add this all up. So our total expenses are $3,075. So we have $3,075. So our total cash flow, positive cash flow, is $175. Okay. Is that good? Is that bad? We don't know. How do we compare? Okay, so we take that $175 a month and we times it by 12. Why do we times it by 12? We times it by 12 because we want to get an annualized return, because that's how we're going to figure out a percentage of return on our investment. And we need to know our return on investment to make sure that this is a good investment that everybody would like to buy. So our return on investment is, so we got 1,200 plus 9, so $2,100 a year. So $2,100 a year, I don't have my calculator because it's on my phone, which is recording us right now. So $2,100 a year divided by $120,000, which our investment was, gives me a number of right around, I'm going to guess, guys. So listen, guys, if I'm wrong, I'm going to post this and I'm going to put all the numbers, correct numbers on. I think it's going to be around 1.75% cash on cash return for our $120,000. So guys, is this a good investment? Would you buy this deal right now? I tell you, it's going to give you a 1.75% return on your investment. Is that good? I don't know. Okay, so let's go ahead. And what else gives us a return on our investment? Right? So what do we do every year that we own this property? Well, we're going to pay down our mortgage. So in the first year, it's about 1 to 1.5%. So it's about $6,000. So here's our yearly. So we got $2,100 from rent. We have $6,000 a year mortgage pay down. Okay, principal reduction. So we have $6,000 a year divided by $120,000. And that would be what, 5%? So we have 5%. So what's our return on investment now? Well, it's 6.75%. Is that good? Is that bad? Is that ugly? What is it? I don't know. Okay. And now we're talking about the Hamilton market or St. Catharines. And the average appreciation has been, the last couple of years has been stupid, yet the historical average is around 4%. So guys, if I'm buying something at $500,000 and I'm putting $10,000 into some quick renovations and stuff like that, I'm probably hopefully getting a lift of at least the same money I put in. So $10,000 will give me a $20,000 lift. So now my value is $20,000. I mean, it's not a huge flip. I'm not going to go sell it because the cost of selling is going to eat up everything. Yet, now my value is a 520 and we do a 4% appreciation a year. Well, I mean, I'm gaining in my pocket my net worth. Now you can't eat net worth, guys. I'm just going to put that out there. You can't eat net worth. Is $21,000. So at $21,000, my return on that per annum, based on my $120,000, is around 20%. For a total return on my investment of 26.75%. And that's at a 4% annualized appreciation rate. So if it's flat, nothing happens, well, we make it our 6.75%. And by the way, every year we own this property, what happens? So this is the magic. This is why I say it all the time. The best time to buy real estate was 50 years ago. Second best time is today. And because if you bought this real estate 50 years ago, number one, you've had 50 years of appreciation at 4% a year. Number two, you probably don't have a mortgage on it, or if you do, you're just refinancing and refinancing and refinancing. Yet every year you pay down the mortgage amount, the principal repayment, it goes up a little bit, right? So you pay a little bit more down on it. And every year your rents go up, right? Even if it's just the 2.2 or 2.3% that we can increase rents on per year, they still go up every year. And on turnover, we're seeing 5, 10, 15% rent increases. So if they stay for 2 or 3 years and then they leave and we get another 10% increase, well, I mean, it just puts our cash flow through the roof. And I know I say you can't eat net worth, yet these are prime things to refinance. And you take a 2, 3, 4, 5 year term, refinance it, and pull out a lot of your down payment. This is really passive. This isn't doing much renovations. It's not doing much. It's kind of just buying, leaving it, and walking away. And these deals are, I mean, they're not common, let's be honest. Yet if you're looking for it and you're willing and ready to go, these deals are out there to find. So guys, you know what? If you want, comment down below. if you need a good realtor in your area, I mean, I'm connected all over the US and Canada. I'm happy to help you out with some recommendations. Guys, like, subscribe, smash that notification bell. Thanks again for coming. We'll see you guys in the next one.